So we invest in listed infrastructure, essential assets. And the characteristic of this asset class, if I may, is to focus on companies that are based on long-term contracts. Those long-term contracts offer two things. First of all, good inflation protection mechanisms. And secondly, very predictable cash flows. They are immune typically from short-term economic cycles. So we are really looking to identify companies with those long-term cash flows which provide sustainable and growing dividends. So our strategy is at the core of listed infrastructure. We focus on typically electric and gas utilities, environmental services, which is typically water and waste, and finally transportation infrastructure. What we exclude is any type of industrial model. We don't invest in equipment manufacturers, again, in order to avoid exposure to short-term economic cycles. So the main structural driver in infrastructure is the fact that we live in infrastructure largely built in the 1950s, 60s, 70s, which today is largely obsolete. So aging infrastructure and the need to invest in infrastructure is a key structural driver, which has emerged actually pretty recently. We hear governments now very focused on that matter. And the percentage of capex out of GDP spent in infrastructure has dramatically declined over the past 40 years, and it's only starting to bounce. With, in the US, a program like the Inflation Reduction Act, which was voted in 21, which is taking a hit now. But more recently, the German infrastructure program voted last year in 25, 700 billion euros to invest in power grid, renewables, transportation infrastructure, three subsegments which are at the core of our investment strategy. So aging infrastructure, the need to replace this, is a core structural trend behind the drivers of growth in our investment strategy. Yes, I see a triple opportunity. The first one is that demand for electricity is bouncing now after 25 years of flat or declining electricity consumption in OECD economies. In the UK, we actually use less electricity than 25 years ago. That's very counterintuitive, very much related to efficiency gains. Now, expectations are that demand for electricity is going to increase by 40 to 50% in the next decade. In the UK, in Europe, or in the US. This is a groundbreaking opportunity of growth for our space. There's a second factor, which is the de-risking of the typical utilities business model. Utilities today are signing long-term contracts, in particular with data centers. This is a new market which only emerged hardly a couple of years ago, where we're seeing contracts signed for 20 years, usually with a clause to renew them for another 20 years. And I mentioned upfront the need to identify predictable cash flows. This goes in that direction. We invest in a space which is less commodity-driven, much more contracted over the long term, and therefore much more predictable. So de-risking, the second factor. And there's a third opportunity, I believe, which comes from the private equity side. Private equity infrastructure specialists have accumulated record amounts of cash over the past couple of years to invest in infrastructure assets. They see the opportunity, they sense the opportunity. The premiums that they are paying for listed assets when they take them private is only going up. And if you compare the valuations used by private equity specialists with the listed valuations of the infrastructure asset class, that valuation gap is as high as it's ever been.